Hey everybody, Signa here with the Bullish Bears. In this video we're going to talk about futures trading strategies. Now this is a question I get a lot. People that want to transition from being a day trader in options or shares get to looking at futures because of all the amazing possibilities that it offers, and then they think that they have to come up with something different in what they do when it comes to trading these, and that's absolutely not true at all. Any day trade tactic or strategy that you've already been using in anything else, you can employ it here in futures market. Now there's two examples of my go-to trades that I lean on all the time. One is a trend trade. For a long time with my schedule, I couldn't trade every single day, and I really wasn't interested in trading every single day either. So what I would do is I would wait for a trend day. Uh, on average, we get 4 to 6 trend days in a month, and I could easily hit my monthly goal with just those days of trading and not have to worry about looking into the market every single day. Now, I reviewed my journal and I pulled up uh, two different places where I was trading. I'll show you a trend day. This is an example of where we had a really good trend in the market. I took advantage of it absolutely. And this is the typical way that I do business. I get risk out and then I leave a runner on trying to hit a profit target. So if you take a look at this for just a moment, you might recognize that it's exactly the same strategy that you would use, right? This is a trend trade strategy. You're trading flags and breakouts, right? Looking for a continuation of the trend. So I got in after what I have termed the Busby. That's when a market breaks through resistance and then comes back to validate that as a support line. At the validation, I typically get in and take it for a run, and I was able to close that out. And then we had the lunchtime. I have my own set of rules that keeps me out of the market during lunchtime. After the market had came back from lunch, repeated the trade one more time and then held it into the close of the day. This is just your regular everyday example of trading trend. One of the nice things about futures is you could get multiple flags in a day, whereas if you're trading something like the penny stocks, you might get one really good flag, and then that's if you miss it, you just miss it. All right, so uh, this was one day in the market. And then not too long ago, really recently, as a matter of fact, we had a really tight range in the market. Now, when we're ranging, I typically go over to the Nasdaq. And the reason for that is just because the Nasdaq moves and it is very consistent with the quarters. And we actually call this running the quarters. You can see it goes from quarter level to roundy to 50 back to quarter level 75s. It just makes these ranges. So when it gets stuck in this pattern, we just hammer it out, hammer it out. All right. If I was able to stay awake, I could have traded a really great trend, but uh, we all got to sleep. I didn't know that trend was coming, and I went to bed. So let me zoom out just a little bit. I'll show you the trades. And when I'm trading range, I typically don't get risk out. I just get in, I get to my target, and I'm done. Now, depending on the range, I might adjust that, but most often when we're running the quarters, I'm just looking to go quarter to quarter. Typically, that quarter is the half or the roundy, 1 quarter away. You can see I was running 2 quarters here, but the price action was so clean that night, I just kept doing it again and again. I did eventually get a loss in there. Third time's the charm. I tried to get slick with this and run it back down and got stopped out. But uh, we we can't win them all, and should have known after that many consecutive trips back and forth that it was going to break the pattern and catch me sleeping. And sure enough, that's exactly what it did. Still a good day overall in the market. These are 50-point moves, and we just kept ranging back and forth through it through the evening. All right, so you got to take advantage of it when it comes. Range trading and trend trading are the fundamental day trade tactics that are applied to all markets, right? And so when it comes to trading futures strategies, the day trade is the absolute go-to, but there also is the overnight swing trade strategy. Now, the way that that works, and I don't have one mapped out here, I should have, but it's been a while since I had one of these. You get in when around the Asian session, and you let the market get far enough away from you that you can go to sleep and put a stop in place so that you cannot lose in the trade. It's really important that you get that initial pop and that the price moves far enough away from you that you can get a stop in place. Now on the ES, that's a lot easier because it just doesn't wick around as much. But on the Nasdaq, you really need some distance in this. I've done it quite a few times, and more often than not, I will get stopped out, but I get stopped out with no loss. That's the key to this strategy. And I'm not going to go in depth on the way that the strategy works. Just recognize that when the Asian session comes on, it's like the opening bell. And we're looking for enough volatility to pop price away from an area far enough that we can get a stop between where we entered and where price is at currently. And then we just leave the trade on overnight and go to bed. Wake up the next day, you wake up with money. Now, this trade, like I said, I have put it on successfully a few times, but more often than not, I get stopped out. It's hard to get the trade. A lot of times, I'll go in and I'll watch the Asian markets, first Tokyo and then Hong Kong, looking for an opportunity to play this trade. And if it isn't there, hey, I'm done. It just isn't there. You don't want to just risk getting into it when price hasn't moved far enough away, because then you're really asking to get stopped out. And the whole idea here is that you want to see a market that made an initial pop, got that good distance away from your entry, and it's far enough away you can put that stop in place so that if the market does come back, hey, it stops you out with enough profit to pay for your trade commissions and fees and all that. And then you're not taking a loss at all. Maybe even you get to keep a couple ticks, right? So it's a decent strategy. You can swing trade these, you can day trade these. Any tactic that you typically use to trade options or shares or whatever it is that you've ever traded before, you can use it in this marketplace. The Nasdaq is a rangy bugger. It will move around on you, okay? But it has a lower tick value than the S&P 500, which moves less but pays you more, okay? So in the end, balancing it out, they're typically about the same. It just depends on what kind of market you want to trade, right? For me, range bound markets, I want the NASDAQ because that range can be 50 to 25 to 50 points, and that makes for a good trading day. When we're trending, I really like the ES because then I'm going to get the most bang for my buck and it's not walking back on me as much. The ES offers me an opportunity to take 30-point trades with 6 ticks of risk, and that's just a really nice way to do business. So there you go, two very straightforward ways to trade the marketplace, two um, that offer the least amount of risk with the highest probability of potential profit. And guys, whatever it is that you typically do, you can continue to do in this market right here. Make sure that you get comfortable trading the futures market that you're interested in. The Nasdaq is not the end all be all, and the S&P is not the end all be all. Deciding which one of those two, and sometimes both at the same time, depending on the kind of uh, level of advancement you've gotten to. All of this is just a part of the different strategies. Now, I mentioned it, so let's go ahead and talk about it. Pairs trading is not just trading inversion of each other. Sometimes you want to trade two different markets in the same direction. Sometimes you want to just take some heat off of your trade. Say I get in right here at the quarter and it continues to pull back against me and I'm looking to go long to get back up to the next quarter. While I'm taking that heat, I could go short in the ES, right? So that allows me to take the heat off of my account, so I'm not taking loss. I'm pretty much breaking even, or I'm reducing it depending on how many contracts I take in the ES, and then I can close that trade after this gets back moving in the right direction. Right? I've done that before. Sometimes it doesn't work, sometimes it does. So pairs trading typically is trading inversion, trading statistical arbitrage. You want to get paid for the split and the difference of the two markets. But that is not the only way to do business. Right? And there's been times where I trade the Nasdaq micro opposite the direction of the Nasdaq mini. Again, taking heat. If I'm long and the market is pulling short against me a little bit, but I still believe in my long trade, rather than bailing out of it, I'll look to take some money to the downside and then flip it back around to ride it back up again. All right, so uh, there are many, many ways to hedge your trade or to reduce your risk in the trade. And these kind of subtle tactics are not just in the futures market. We've discussed that many times, trading options, trading pairs, and looking at different ways that we can reduce our risk. And that's really what it all comes down to, right? Is reducing our risk in the trade. So I look forward to seeing you at the next video.